Welcome to the Deep Dive, unpacking the Fed's potential September rate cut, sparked by weak jobs data and its economic impacts.
You know, it feels like just weeks ago, the Fed was being extremely cautious about cutting interest rates.
Yeah.
Very measured tones.
Definitely holding back.
And now,
Yeah.
suddenly it's like the whole market's flipped.
Yeah.
Pricing in an, 85% chance of a rate cut in mid-September?
85%. Yeah, it's a really dramatic swing.
It is. So what exactly caused that? What was the big trigger for such an abrupt shift?
Well, welcome to the Deep Dive. This is where we take the sources you send us and really try to unpack what's happening underneath.
No.
And today, we're digging into exactly that. We've got reports from Reuters, ING Think, Kiplinger, all trying to make sense of this sudden surge in expectations for a Fed cut.
Okay.
So our mission really is to explore why the odds shot up, what the different expert takes are, the nuances, and importantly, what it might mean for you.
Got it. So the big question is, will the Fed actually do it? Will they cut in September? And what's driving this near certainty the market seems to feel? Because it really did feel like an overnight change.
It almost was. I mean, this massive shift in expectations, it seems to boil down to one key event, a surprise that landed on August 1st.
Which was?
The July jobs report. It came in surprisingly weak, and that seems to be the main catalyst.
Okay, but before that report, Powell was still playing it cool, wasn't he? I remember at the late July meeting, Fed Chair Powell, he definitely avoided signaling cuts were coming soon.
Oh, absolutely.
He kept saying things like, made no decisions about September.
Yeah.
Too soon to say, wait for more data. What was the thinking there? And how did the market react initially?
Well, the thinking, I think, was clear. Manage expectations, keep options open, don't let the market get ahead of itself.
Right.
And it worked for a bit. The odds of a September cut, which were actually pretty high before he spoke, around 73%, they dropped, fell quite a bit, down to maybe 46%, even touched around 38% right after that FOMC meeting on July 30th.
Wow.
So the market kind of resigned itself, thought, okay, we're waiting longer.
But then came that July jobs report. You said it was dismal. What was so bad about it? Because clearly, it changed everything.
It really did. I mean, first, the headline number. Only 73,000 jobs added. The expectation was closer to 100,000, so a big miss.
Okay, that's low.
But maybe even more significant were the revisions to the previous months. They revised payrolls down by a massive 258,000 jobs.
So wait, 258,000 jobs just disappeared from the prior data.
Vanished, exactly. And on top of that, the unemployment rate ticked up slightly to 4.2%.
Okay, those revisions sound huge. What's the deeper meaning there, economically speaking, when you see history rewritten like that?
It changes the picture, definitely. Kiplinger pointed this out. They quoted LPL Financial's chief economist, Jeffrey Roach, who apparently called the downward revisions the most revealing aspect.
Revealing how?
His take was that it showed business demand for labor is slowing much more significantly than we realized. It wasn't just a soft month. It suggested the trend was already weaker.
Like the warning signs were there, but maybe hidden until those revisions came out?
Exactly. And the market reaction was, well, immediate.
So how fast did things pivot after that report hit the wires?
Instantly. Reuters described it as sparking a dramatic rethink. Kiplinger noted the odds for September just skyrocketed overnight from that low 38% right up to about 80.8%.
Just like that.
Just like that. And the CME FedWatch tool, which tracks this stuff, quickly showed 85%. It was an undeniable flip, like someone threw a switch.
Okay, so that sets the scene. A really dramatic turnaround. Let's dig into how the different sources are viewing this. Starting with Reuters, they focused on that dramatic rethink and the internal Fed debate stirred up.
Yeah, Reuters really captured the immediate market shockwaves after the jobs data.
Or the big signals.
The bond market reacted very strongly. U.S. Treasury yields dropped sharply, hitting their lowest in over a month. The 10-year yield had its biggest one-day fall of the year.
Significant moves.
Very. And maybe even more telling, the yield curve steepened a lot. Widest spread in 3 years, apparently. That's a classic signal traders see when they expect the Fed to start cutting rates, easing policy.
Right. And what about other markets?
Well, the dollar weakened, or swooned, as Reuters put it, and stock futures jumped as investors started pricing in that potential monetary relief. Big, clear signals across the board.
And Reuters also dug into the Fed itself, right? This idea of a fractious debate. What does that mean exactly? Doves versus holdouts.
Yeah, they painted a picture of a Fed that's really not on the same page. It's not unified. They highlighted that double dissent at the July meeting, which is rare, apparently the first since 1993.
Two governors dissenting.
Christopher Waller and Michelle Bowman, they both argued the Fed should have cut rates right then in July. They saw growth slowing, the job market cooling.
And what was their main point? Why cut immediately?
Bowman framed it as a hedge, basically. Cut proactively to hedge against further weakening and potential damage to the labor market.
Okay, a risk management argument.
And Waller argued, why wait? He said the Fed should not wait until the labor market deteriorates before we cut. Get ahead of the curve. Their voices definitely add weight to the cut-sumer camp.
But there were other voices too, right? More cautious ones.
Definitely. Reuters balanced it out. They mentioned Cleveland Fed President Beth Hammack, who sounded confident about holding rates steady in July. She saw the labor market as largely in balance and reminded everyone inflation was still above target.
Still focused on inflation.
Right. And Atlanta Fed's Raphael Bostic initially agreed with holding tight too, though Reuters noted he did acknowledge the significance of that weak jobs report later.
So it really highlights that tension within the Fed, doesn't it? Balancing jobs and inflation.
Exactly. It shows the internal struggle. These differing views mean a September cut isn't necessarily a slam dunk, even with the market odds. It underscores the uncertainty. The key thing from Reuters isn't just if they'll cut, but how divided they seem to be internally.
And Reuters even touched on the political side of things.
Yeah, they mentioned President Trump firing the Labor Department's statistician after the report and his public calls for rate cuts. They used some pretty vivid language like morning bid, payroll soft, messenger fired, adds another layer of, well, drama to it all.
It certainly does. It shows how all these things, data, Fed internal talks, politics, they all swirled together.
It creates a very volatile mix. But importantly, not everyone is buying the September cut story despite those odds. And that leads us nicely to ING thing.
Ah, yes, the counterpoint. ING seems much more skeptical, right? Even with the market at 85%.
Very skeptical. They basically said, we are not so sure about September. They flat out argue that the September meeting will come too soon for the Fed to be comfortable cutting rates.
That's bold, going against such strong market pricing. What's the reasoning?
Their main worry seems to be inflation. Specifically, they're concerned about a temporary spike they expect this summer because of President Trump's tariff policies.
All the tariffs again.
Right. They think those could push the monthly inflation readings, the CPI, higher in July, August, September, maybe by 0.4% to 0.5% each month. And they think the Fed can't just ignore that.
And they also bring up the Fed's past experience with inflation.
Exactly. They reminded readers the Fed got stung when it called inflation transitory back in 2021-22, and it wasn't.
Right, that didn't age well.
No. So ING argues the Fed will not want to cut rates on a hunch now, only to maybe have to reverse course if that tariff inflation sticks around longer than expected.
So they think the Fed will wait for more proof.
That's their bet. They argue the Fed will want to see the October and November CPI reports first, which means waiting until mid-November or early December for that data. They want confirmation that price pressures are really easing after the tariff impact has hopefully passed.
So ING's big takeaway is basically, don't trust the market hype. The Fed's memory of the transitory mistake plus the tariff wildcard means they'll likely wait for solid proof.
Pretty much. Patience over preemption, you could say.
And ING also mentioned the Fed's own projections, didn't they? Something about how many members didn't even see cuts this year.
Yeah, that's another key point for them. Even back in June, 7 out of the 19 FOMC members projected 0 rate cuts for all of 2025.
7 members. That's a significant minority, or maybe not even a minority.
It suggests the bar for getting consensus on an early cut, like September, is actually quite high. So while they acknowledge the job market is cooling, ING sees it as more gradual, not yet a crisis.
So how does that translate into their actual forecast? If not September, then when?
They think the Fed will wait until it's completely comfortable, as they put it. So their forecast points to a later start, probably December 2025.
December.
And maybe, just maybe, if the data clearly shows a downturn by then, they might go for a larger 50 basis point cut. They drew a parallel to how the Fed waited in 2024 until they felt sure before making a move.
Interesting. Patience rewarded with a bigger step, potentially. That's a very different narrative than the market's pricing.
It is, and it puts the political pressure aspect in a different light, too. ING acknowledges Trump's calls for cuts, but their analysis implies the Fed will try to hold firm, stick to the data, even if the political noise gets louder.
Right. How much does that outside pressure really influence them? Always a tough question.
Indeed, it tests that idea of central bank independence.
Okay, let's pivot to our third source, Kiplinger. They come at this more from an investor angle, right? Focusing on the surging odds and what it means for your money.
Exactly. Kiplinger frames it very directly for people managing their finances. They highlight right away. Probability the Fed cuts interest rates in September is back above 80%. Very clear.
And they track the roller coaster ride, too.
Yeah, they did a good job showing those wild swings over the summer, starting high at 73%. Then Powell's comments knock it down to 38%. Then bam, the jobs report sends it rocketing back over 80%.
It really visualizes the volatility for investors.
Absolutely. It shows how fast things can change, how market sentiment can turn on a dime based on one piece of data.
And Kiplinger also used that jobs data, the low headline number, those huge revisions to back up the shift, right? Including that quote from Jeffrey Roach again.
They brought back Roach's quote about the downward revisions being the most revealing aspect and how it solidifies our view that the Fed could cut rates in September. So they connect the data directly to the increased probability.
But Kiplinger looked even further ahead than just September, didn't they? What about later in the year?
Yes, that's a key part of their analysis. They reported that the futures market isn't just betting on September. It's pricing in, 60% chance of another quarter-point cut in October.
Another one soon after?
And even majority odds, as they put it, of a third 0.25% cut in December.
Wow, so the market's thinking 3 cuts by the end of 2025.
That's what the pricing implies, yeah. 3 quarter-point cuts, which would bring the Fed funds rate down significantly, maybe into the 3.25% range. That'd be the lowest since 2022.
Okay, so Kiplinger lays out this market expectation for multiple cuts. How do they then translate that into advice or implications for regular investors? What does it mean for you?
This is where Kiplinger really shines, connecting the dots. They stress that rate cuts generally mean good things for certain assets.
Like what?
Well, they tend to boost bond prices because yields fall, and they're usually seen as positive for the stock market overall.
Any specific sectors?
They specifically mentioned tech stocks and small cap stocks often do particularly well when interest rates are falling.
Okay, that's concrete.
Yeah, their whole approach is practical, using headlines like, how big will the Fed rate cut be this fall? Or how to invest for a fall interest rate cut. It makes it immediately relevant if you're thinking about your portfolio, your mortgage, car loans, anything sensitive to interest rates.
So their key insight is really the market expects easing. Here's how that could play out in your finances and potentially how you might position yourself.
Exactly. It treats Fed policy not just as news, but as something with direct financial consequences for individuals.
All right, let's try and pull all these threads together. We've heard from Reuters, ING, Kiplinger. What are the main takeaways when you synthesize these different views?
Well, first, the obvious point of agreement. All three confirm that market expectations for a September rate cut absolutely surged, hitting that 85% probability mark.
Right.
And the main driver, universally acknowledged, was that weak July jobs report, especially those big downward revisions. The market sentiment shifted dramatically. No question about that.
Okay, that's the common ground. But then they diverge, offering unique perspectives.
Definitely. Reuters gave us that sense of dramatic rethink, but also crucially highlighted the internal Fed divisions, the fractious debate. They added the market reaction color and the political backdrop. It paints a picture of uncertainty despite the market odds.
The messy reality behind the number.
Then ING thinks steps in as the cautious voice, the skeptic. They deliver that strong counterpoint. September may come too soon. Their focus is on the inflation risks, the tariff unknowns, and the Fed's likely desire to wait for undeniable proof, remembering past mistakes. They suggest a later, maybe larger cut.
The voice of prudence, perhaps.
Could be. And finally, Kiplinger brings it home for the investor. They track the odds, explain the why behind the market move, but most importantly, translate it into, what does this mean for your bonds, your stocks, your financial decisions? Very practical.
So we have the drama and division from Reuters, the cautious skepticism from ING, and the practical investor angle from Kiplinger.
Precisely. And stepping back, why does this all matter to you listening? Because the Fed's decision isn't just some abstract economic policy. It directly influences the interest rates on your mortgage, your car loan, your credit cards. It affects how your retirement savings perform in the stock market. This whole will they or won't they dance around rate cuts. It's a really pivotal moment for the economy, and the outcome will ripple through everyone's finances in one way or another.
Okay, so wrapping up, We've seen the market get incredibly convinced, like 85% sure, of a September Fed rate cut, mostly thanks to that jobs report. Shocker.
Near certainty priced in.
But we've also heard strong arguments, particularly from ING Think, urging caution, suggesting the Fed, burned before and worried about tariffs, might just wait for more solid data before pulling the trigger.
Yeah, the debate is far from over, despite what the market odds say.
So here's a final thought to leave you with. We know the Fed likes to wait until it's, quote, completely comfortable before making significant policy shifts. And we know there are still real concerns about inflation, especially with tariffs looming.
So will they actually cut rates in September? Or will they push back against that 85% market expectation and wait? And thinking beyond just the jobs numbers, what other data points, what signals will you be watching closely in the next few weeks to form your own view on when those rate cuts might finally begin?